Brad Williams, Frugal Finance, valuation of a leased fee estate. Properties are often purchased subject to existing leases, and the terms in these leases must be honored by the investor. In this case, leased fee estates are acquired by investors. The existing leases may have above or below market rental rates that affect the value of the lease fee estate. To illustrate, assume that instead of earning $500,000 per year, the office building evaluated in the previous example has an existing net lease with a remaining term of 5 years at a flat rate of only $400,000 per year. How does this affect the value? The value will clearly be lower because the rents will be less for the first 5 years. The value at the end of the 5-year lease term should not be affected. However, because the property may be leased at the market rate at that time, that is, the income for the remaining economic life of the property should be the same as if it had not been encumbered by the below market lease. Thus, the resale price would be $596 with some change. As for the fee simple value estimate made earlier, we can now estimate the value of the lease fee estate as the present value of $400,000 per year NOI plus the present value of the estimated value at the end of the lease of $5.7 million. Where we calculate the present value, one additional question must be considered. Should the discount rate still be 13%? The answer depends on whether the lease fee estate is considered more or less risky than a fee simple estate. This depends in part on the creditworthiness of the tenant. The lease represents a contract between the lessor and the lease. The riskiness of the NOI collected during the term of the lease is dependent on the riskiness of this financial contract. Of course, if the tenant defaults, the owner has the right to attempt to lease the property to someone else at the market rate. Point is that by leasing the property, some of the risk of owning the property and collecting current market rents is exchanged for the risk of collecting on the lease contract. Because the existing lease is at a below market rate, it is likely that there will be a default on the lease, especially if the property could be subleased. Furthermore, it's more likely that the owner could lease the property at a rate higher than its current lease rate rather than lower. Thus, a discount rate slightly lower than 13% might be justified. We will assume that a 12% discount rate is appropriate. Building NOI for 5 years with leases at market rate, $500,000. Property valued at end of year 5 equals $5 million. These are numbers you're entering. Term, 5 years. Actual NOI, another building with the same loan terms and interest rate, $400,000. Term, 5 years. Property value, they're using a simple cap rate. All they're going is 579,367. I don't know where this number came from. This was some number out of left field right here. They just said the NOI plus the present value is, they said the resale price would be 579. And this particular example, I don't know how this was derived. They're saying there's a net OI of 579,000. And all they did was divide it by 0.10. And then what's the value with the below market lease rate? They use this, PV 12.5, 400 versus the 579. They're saying here's the value of the market lease 464. And this 359 is C31, which would be this 5 million and minus this 464 is 359. In this case, the difference between the value of the fee simple estate, $5 million, and the value of the lease fee estate, $4.6 million, sure reflect the value of the leasehold estate, which is $359,000. That is, the below market lease results in the value of the fee simple estate being divided among the leasehold and the lease fee interests. You have to applaud the simplicity here. If you just need a back of the envelope approach, you can use this approach here, which is just the present value on some arbitrary number. This 5.7 million, I don't know where it came from, but it is probably the same approach here, where they just used a cap rate to come up with this number. And you can do the same thing here. You can use a cap rate to value some other hypothetical situation. But real estate's real estate, stocks are stocks, swaps are swaps, derivatives are derivatives. They all have certain characteristics. Brad Williams, Frugal Finance, thanks for watching.